Now, as we turn into the international market, it's important to look at what's happening in Russia and how Russian flows are changing from the crude side, from the product side. And it's interesting because we actually had to delay filming of this because we did get some new data on the diesel front, because it's important to look at how refined products are really shifting and what does that mean for underlying flows. So here you can see OPEC did come out and reduce their demand side. They took Q4 down a little bit, but when you're talking about an estimate of 101.25 million barrels a day, and they're taking it down 140,000. I mean, it's a rounding error. So when we look at some of this, we still think demand is overstated here. We do see more downside, especially when you just look at the U.S., the demand that we've averaged there. When you start looking at China, when you start looking at India, one of the problems that we see in general is the slowdown in just manufacturing, because diesel is a huge part of the manufacturing puzzle, and we see that dropping more aggressively, which again is going to pull down some of that. It won't show up as much in Q4. There's still some of this, which is why we think Q4 is overstated. But they did take a bigger write down in Q1 of next year, and that's where we see a much bigger slide down in demand, given where things are on just an economic basis. And then as you extrapolate out, because distillate demand, diesel demand has been fairly stable, if not more robust. ASEAN nations are seeing their manufacturing drop off aggressively, still in expansion, but falling. We do expect it to be in the contraction this month. India, same thing, some of those slowdowns. So that's going to overhang. They're starting to get in front of it, but we do see more of that downside as we go into next year. Now, when we look at crude oil production, you can see that there was a drop of 744,000 barrels a day, and you can, in terms of what was the driver of it, Saudi Arabia, it was the biggest component of that drop. It's a matter of which do you believe, what was reported, what was not reported, what was secondary sources. So when you look at some of the drops in November, it's interesting because you had a drop in November, but you did have builds happening in the offshore market. So here's where they provide opportunity. So when you think about keeping their OPEC targets flat, it's flat, but you're already below where you should be right now, and a lot of that is just driven based on where demand is. So when you look at Russia set up an oil transfer site in the Baltic Sea. So Russia set up a site to allow it to transfer refined fuels from one vessel onto another in a bid to help it overcome a stretched tanker market before the onset of European Union sanctions. So they're trying to figure out ways to move that product easier, because that is going to be a very big component of how they try to manage it. Now, when you look at OPEC production, it's come down, but how much of that was because they wanted it to, and how much of that was because they couldn't sell it because it was priced incorrectly? And that's when you start looking at the EIA saying that they see price increases because of Russian sanctions, where realistically, if Russia says we're going to sell to countries with a price cap, or we're going to say nothing, we're going to say we're not going to sell them with a price cap, but we're still going to sell to them with a price cap, that's going to make the market a little bit easier, because you're going to shorten miles per ton. You're going to loosen up the market a bit. You're going to bring down shipping costs. You're going to bring down insurance costs, which would then bring down the price of crude. And as we've spoken to a client just recently, we don't think there's much up or downside in crude pricing here. Realistically, there's probably more downside in Q1 purely because of economic reasons, a slowdown in manufacturing, a slowdown in activity, a big build in refined products as Russia does ship-to-ship transfers. They tried to send more product into the Middle East. The Middle East then commingles this product and then either consumes Russian product internally and then exports 100% of their own, or commingles it in storage and then exports it under their own flag. There's going to be ways to move that through the system. And one of the key pieces is the offshore oil hoard in Asia has fallen. So when you look at what has come down, there's more opportunity to move some of these additional barrels, especially in Russia, into this market, which is why more of the crude that's leaving from Russia into Asia is filed under quote unquote unknown, because it can sit there and they can try to be proactive and get it closer to where it needs to be without a firm buyer, because they know at the end of the day Asia will be their largest buyer. So that's going to put some of that additional crude in both Singapore as well as China as they wait to see, what is the best deal they can work out. The volume of stored has halved from a year earlier to around 30 million barrels. There's been a significant decline of Iranian crude in floating storage since late September, with a large portion put into onshore tanks in China. So China's also cleared some of the glut. They've been able to take some of it into their onshore tanking, but you've had some slowdown in Iranian. You have had some. So when you look at the flows, and the Iranian drop is because they have issues at home. They have uprisings. The oil workers are supporting the current movement in protests, which is impacting the amount of crude they have available to put onto the water. So as that comes out, there's going to be more reliance on that Russian crude, because Russian Urals, Iranian crude are easily swapped for the most part. So that would enable countries, especially in India as well as in China, to try to swap that out, which is going to put some of those additional crudes into the market. Russia, here's what we were talking about. China and India continue to be the bright spot, but the unknown. So you've seen a big surge in Russian flows into Asia, and it's coming under the flag of unknown, because they know the buyers are there. That's where they're going to purchase. They're going to say that there is no destination. They may do some ship-to-ship transfers, put it under the Malaysian flag, and then flow that into the ASEAN nations as well as China, but trying to get in front of it. And then Russian seaborne crude, when you look at flows, into Northern Europe, Southern Europe, have slowed down. But then when you look into unknown, slightly increasing. When you look at some of those different destinations, we do think that, again, the price cap is not going to stop Russian exports. It's going to legitimize them. We've already seen Kazakhstan talk about using underutilized or no longer used Russian pipes to get product from Kazakhstan into Germany. And it's important because there's ways to blend in Russian Urals into that mix. And then Kazakhstan could pay a kickback to them in order to take in their crude, increasing volume. And we've seen that happen with Iran and Iraq. When you look at what's coming through Basra, typically when Iranian sanctions are lifted, all of a sudden Iraqi exports come down as Iranian imports lift. In Malaysia, typically when countries don't care about taking in sanctioned crude, Malaysian imports come down. Iranian, Venezuelan, Russian crude imports go up. So again, you always have that back and forth. Now, another important piece is the diesel shipments. Diesel shipments into Europe, soar ahead of Russia. Europe is bringing diesel cargoes from around the world at close to a record pace ahead of the coming ban on shipments. In the first 10 days of December, the UK and EU imported more than 16 million barrels of diesel at a very healthy clip. Europe is structurally short diesel, as they've always relied on imports. With much of December's arrivals coming from Asia and the Middle East, the shipments provide, kind of a glimpse of that shift, which is what we've been highlighting. We've been talking about that east to west Suez, where India has been dumping a lot into the Atlantic Basin, the Middle East has, and that's going to continue. But that doesn't mean that the U.S. and the Gulf of Mexico is going to slow, because the Gulf of Mexico can undercut Middle East and Asian cargoes because the distance of shipping, cost of shipping. So we can undercut that. And then as these cargoes come into the Atlantic Basin, there can be competition of, do you flow into Europe or do you flow into the US based on where you're going to get the best price. Now, when you look at China, a key component that we wanted to look at, China's imports of crude are already at the highs. And we talked about this last week, but we wanted to reiterate that the biggest shift on a reopening is not going to be a big increase in Chinese imports of crude oil, because they've already increased it. It's going to be, what are their exports of refined products? So they've increased imports of crude, but they've also increased imports of exports of refined products. So what could happen if they do get a sizable uplift in demand and activity in China, you'll have oil demand staying the same, but you'll get a big drop in exporting oil, which then would open up an opportunity for Asian refiners, because this would alleviate some of the pressure we've seen from Chinese gasoline, Chinese diesel, pushing down refined crack spreads. And right now, based on the current economics, you're likely to see economic run cuts. If we do see a bigger drop in Chinese exports, that would alleviate the need for economic run cuts and keep demand a bit stronger in the Asian markets, which is not our base case. So you look at Middle Eastern crude and floating storage, it's starting to flatline. So you had a sizable drop, and now you're struggling to see this clear again, because again, a lot of the crude has been purchased and pricing is still too high. You've seen the prices come down in the floating market. You've seen OSPs get cut, and now it's just a matter of, well, do I need any more crude going into year end? And the answer is no. A lot of guys have already bought in January. You're already looking into February and really March, and you have a lot of crude and floating storage in the Middle East. So this is why we do see them getting more aggressive on OSPs. It's another reason why they cut production a bit faster and harder than what was expected, because, well, why am I going to pay for floating storage? Floating storage is so expensive right now because of tanker rates, so leave it in the ground. You know, they do have some spare capacity in onshore storage, but based on this, there's no impetus to drive and increase the amount of product in the floating market. U.S. exports remaining at a high. This is, again, moving into the European theater. We still see this remaining at a very high end. When you look at Dubai versus Brent, you can see that it's come down a bit, but it's still, Dubai is still trying to compete. And that's why West Africa, you're seeing steeper OSP cuts, steeper spot price cuts. But Brent prices, you had a nice little bounce. You know, we've had some Norwegian crudes pricing a little bit higher than where they were previously. Again, it was from $5.95 below dated Brent to $5.50. So you're still well below dated Brent. You're still trying to compete. It's just the discounts aren't as good as they were, while in the Middle East, in West Africa, they're actually getting better as West Africa is trying to clear some of that glut. Crude oil in the water coming down, but still just slightly off the 2022 highs. We still see a lot of crude on the water staying there, especially as Russia tries to push as much as they can ahead of it, and even without an unknown, or at least as they declare an unknown location. And then oil in transit coming down a bit, but still at 2022 highs. We still see this staying at a very high, elevated level because of miles per ton remaining elevated. You just have a ton of cargoes just moving around the world. Then when you look at floating storage, as we were saying, the comps get easier. We expect to close out right where we were in 2021, 2020. And it's just going to be a matter of the timing delay. We could be above it depending on when these ships in transit show up in floating storage. You know, there will be those delays because of the holidays, because of Lunar New Year, which is going to spike floating storage. The question is always going to be a matter of when does it show up, but we don't see it falling much lower. Asian floating storage starting to flatline. We expect it to grind higher and close closer to where it was in 2021. Again, back to the comments that we made in the previous, because a lot of that floating storage or crude in transit is targeting the Asian markets. So it's just a matter of when does it show up on its doorstep. And here's some of that support with Chinese super tankers coming down, but still well above seasonal norms. And this is because we did see a swath of buying from some of the guys in Shandong. And it's just they're taking advantage of these steep discounts in West Africa, which makes sense given the fact that they've increased runs a bit. And they're trying to take advantage of some of the discounted crude, which when you look here, you know, as they had a small drop from 67.1 to 65.9. We do see more upside, though, and something moving closer to 69%, 70%, given the reopening, given where they are in the cycle. We should see some additional activity as we go into year end and, more importantly, into Q1. West Africa floating storage dropped. We do see this reversing, not so much back to the highs that we saw in 2021. We did get some of those cargoes move into go into transit, going to the U.S., going to Asia, but you can still see that we're still at that elevated level and likely to remain at that point. U.S. exports remaining strong. Motor gasoline increased 191,000 barrels a day, well above the 5-year. Distillate, same thing. Propane, small drop, but still very strong. When you look at gasoline, it's going to stay at the very high end of the cloud, well above the 5-year average. That's something that is going to be fairly sticky. Distillate, again, same thing. The market is there. PADD 3 builds keep climbing. On the storage side for distillate, the only way to really alleviate that is to get it into the exporting market. Even though cracks have come down, prices have come down, it's still profitable. The arb is still open going from the U.S. into Europe, which is going to keep a lot of those cargoes flowing. Crude oil exports still staying strong, not adjusting all that much, with propylene coming down a touch, but still well above the at the top end of the cloud, still going to remain elevated. When you look at Fujairah, we had builds across the board. They came in at 24.36 million. That was a build of 1.507 week on week, back above that 24 million barrel a day mark. When you look at light distillates, had a build of 633,000. That's 7.766 million barrels. East of Suez complex strengthened during the early trading as demand from the Philippines went up a bit, as you had some late holiday buying. But when you look at gasoline supplies, will continue to outpace demand, and a lot of that is driven by Chinese exports. And then some loosening of COVID restrictions and increase in travel showed India's year-on-year gasoline consumption rise despite the end of the festivities. So you did get some of that demand, but there's a lot of supply out there, and you do have that base effect dropping off. You do have the slowdown for the holidays after everybody's there. And that's where we think light distillates, as we said 2 weeks ago, we expected builds last week. We expected builds this week. And here we think we kind of flatline a bit. We could get a small draw, but realistically, we're going to stay right around this level. Middle distillate rose 652,000 barrels to 3.812 million. East of Suez gas oil market was slow with uncertainty around Chinese domestic consumption and export volumes. So we do see that spot market has been fairly muted because you've seen some sellers and a wait and see because you're starting to see a softening at the flat prices side, with the demand outlook also faltering. And a lot of that is driven based on the recession, the slowdown in manufacturing, which we've been talking about, and we do think starts to gain a bit more steam. Heavy resid had a build of 222,000 barrels to 12.782. Spot trading activity at the bunker hubs were fairly lukewarm, and a lot of that is because flat pricing is getting weaker, and you have that slowdown in underlying shipping. Brent time spreads bounced a bit. You're still in contango. You're still at negative 15 cents, and we think just based on where some of the metrics are right now, you're likely to be slight contango or flat pricing at this point, just based on the competition that we're seeing in the market. When you look at flows, Norway still moving higher. When you look at Nigeria, same thing. Angola, North Sea, all staying strong. Chevron offered 1 million barrels of Nigerian Usan crude at a loading of $3.70 less than dated Brent. And if you look, it was at 230, 280, 295. So now they was at 290. So they had a big jump from 295 to 370, just trying to clear that crude. Senegal spot offers, they reduced. We had multiple reductions. They went from $1.75 minus dated Brent to 225. minus $2 to minus 250, minus 375 to minus 425. So again, you're seeing a lot of those softness. In general, when you look at it, Nigeria's Qual Ibo saw its premium to dated Brent slump by nearly half last month, shedding $1.35 to $1.41 per barrel. Another just indicator of the pressures. Glencore did see a little bit of an adjustment. Glencore bid Johan slightly less than where it was previously. It was at a discount to $5.95. Now it's at a discount to $5.50. Dated Brent, still very much a decline, but it's just a matter of trying to clear those gluts. And when you look at the differentials, they're pricing it to move. And that's not something that's going to change based on where expectations are for Nigerian production, Angolan production, the headwinds we see on demand, and just the amount of crude and floating storage. European builds had a small build. You can see that we're back to the highs. We're actually back to where we were in 2020. We see a lot of staying power here given the amount of crude and floating storage and the slowdown in demand. When you look at the products, you had a sizable draw in gasoline naphtha, and sizable build in gas oil and fuel oil. Gas oil, you're still at the very low end of storage. That's not something that, even with imports, you can see even with this huge surge in imports, we only had a small build of 49. We'll likely get a sizable build this week because remember, this data comes out tomorrow. We'll talk about it on the FSC show, but we should see a little bit of an increase. When you look at gasoline, a small drop, but still seasonally adjusted all-time highs. We don't see that changing. Fuel oil, again, staying at the high end. It's just going to be a matter of, can they sell it? Likely not. So, can they recrack it? And then when you look at Singapore had a drop of 2.3, just under 2 million. A lot of that was driven by light distillate and middle distillate. Here you can see, based on what we were saying, we're right around the average. We don't see that changing on the total fuel stockpiles. Because if you look, we've been going between 40 and 43 and just going back and forth depending on the time. Here you can see that light distillate dropped, but still, if you look at it seasonally adjusted, still very much towards the highs. We do expect to see that bounce again. On the middle distillate side, you can see the drop just hugging that bottom end. We don't see that changing realistically or meaningfully off that low point. And then on the heavy resid side, the heavy disti resid side, we expect it to stay very much along the average. And then when you look at North Sea, fairly flat. We see it pretty much holding firm, maybe a little bit of an increase in floating storage. Europe had that huge spike. That just means that we expect to see a lot of that come onshore. So a drop in floating storage, an increase in onshore storage. So realistically, looking at the whole, we're going to get a lot of Russian flows coming through, trying to plug that hole, get that product in the market, ahead of the February new sanctions. So that means that December, January, February, we're going to see a lot of Russian diesel getting pushed into the market. That's going to have to be absorbed somewhere. That'll put pressure on crack spreads. Not only do you have Chinese exports, now you have Russian exports to contend with, which we think is going to put a bit more of a downside bent on disti cracks and underlying crude demand. And that's on top of just slowing demand from economic pressures as manufacturing contracts in ASEAN nations, India, and then global manufacturing continues to be in contraction as, again, exports slow further. So that's what we have for you today. If you have any questions, you can find us in the comment section. You can find us on Twitter. And thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.